Every 7 seconds, someone becomes a millionaire from the stock market. And every 7 seconds, someone else loses their entire life savings. Same market, same stocks, same economy, completely opposite outcomes. So what's the difference? What do the winners know that the losers don't? It's not luck. It's not insider information. It's not some genius-level IQ. It's understanding one simple thing that takes about 20 minutes to learn, but that most people never bother to figure out. Here's the crazy part. Exposed to stocks your entire life. You've heard about them since you were a kid. Your parents talked about them, the news talks about them, your coworkers talk about them at lunch. But if I asked you right now, what actually is a stock? Could you explain it? Like, really explain it? Most people can't. And that confusion, that I'll figure it out later mentality, it's costing you hundreds of thousands of dollars, maybe millions, and you don't even realize it's happening. And if you think that sounds dramatic, wait until I show you how waiting just 5 years cost me personally $847,000. We'll get to that. I'm Finn, your finance buddy, and today I'm going to explain stocks in a way that actually makes sense. No jargon, no confusing charts, no pretending you need a finance degree. In this 20-minute video, it's going to give you an advantage most people never get their entire lives. Because here's the truth nobody tells you. Stocks are simple. They are deliberately made to look complicated so that banks and advisors can charge you fees to manage them for you. You've been lied to your whole life by people who profit from your confusion. And I'm about to prove it. By the end of this video, you'll understand exactly what a stock is, how the stock market actually works, why people make and lose money, and most importantly, why not understanding this is quietly draining your future wealth right now. If you've ever felt intimidated by investing, if you've ever thought, I'm just not a money person, this video is going to change everything. Comment right now. Do you actually know what a stock is? Be honest, no judgment, because what comes next might shock you. Let's begin. Let me tell you about my friend Marco. Marco owns a pizza shop. Best pizza in town. Seriously. The dough is perfect. The sauce is his grandmother's recipe from Naples. People line up around the block on Friday nights. But here's Marco's problem. He wants to open a second location. The demand is there. The customers keep asking. But opening a new restaurant costs money. About $200,000. Marco has 3 options. Option 1, he could take out a bank loan, borrow $200,000, pay it back with interest over 10 years. But if the new location fails, he still owes the bank. He could lose everything. Option 2, he could save up the money himself. But at his current rate, that would take 8 years. By then, his competitors might have taken over the neighborhood. Option 3, he could sell pieces of his company. This is where stocks come in. Imagine Marco's pizza shop is a pie. And I don't mean a pizza pie, I mean a financial pie chart. Right now, Marco owns 100% of that pie. The whole thing. Every slice. But what if he cut that pie into 1,000 slices? And what if he sold 500 of those slices to other people? Each slice is called a share, and a share of a company is called a stock. When you buy a stock, you are literally buying ownership in a real business. Not a lottery ticket, not a casino chip, actual ownership. If Marco sells 500 shares at $400 each, he raises $200,000. He can open his second location. And the people who bought those shares, they now own half of Marco's pizza empire. Now here's where it gets interesting. Let's say Marco's original shop was worth $400,000. He sold half the company for $200,000. Makes sense, right? But 3 years later, Marco has 5 locations. The business is absolutely crushing it. Now it's worth $2 million. Remember those people who bought shares for $400 each? Their shares are now worth $2,000 each. They made 5 times their money just by believing in pizza. That is the power of stocks. You're not just buying a piece of paper. You're buying a piece of someone's dream, someone's hard work, someone's potential. But here's the flip side. What if Marco's second location flopped? What if a health inspector shut him down? What if people suddenly decided they hated pizza? Those $400 shares might be worth $50. Or nothing. That's the risk. Stocks can go up, stocks can go down, sometimes dramatically. But here's what nobody tells you. Over the long term, over decades, the stock market has gone up almost every single time. Not every day, not every year, but over 20, 30, 40 years, up. We'll talk about why that is in a minute. But first, I need to show you where stocks actually live. And real quick, if you've ever bought a stock without really knowing what it was, trust me, you're not alone. Most people have no idea what they actually own. Before we go further, let me kill 3 myths real quick. Myth 1. Stock prices are set by accountants or some official board. Nope, they're set by supply and demand, by millions of people buying and selling. Myth 2. When you buy a stock, the company gets your money. Almost never true. We'll explain why in a second. Myth 3. The stock market is basically gambling. It's not. And I'll show you exactly why people think that and why they're wrong. Okay, now let's talk about where stocks actually live. When I was a kid, I thought the stock market was a literal market, like a farmer's market, but instead of vegetables, people were selling stocks. I pictured guys in suits standing behind tables yelling, "Get your Apple shares here! Fresh Amazon, just picked this morning!" That's not exactly how it works. But honestly, it's not that far off. A stock market is just a place where buyers and sellers meet. That's it. Nothing more complicated. You want to sell your shares of Tesla? Someone else wants to buy shares of Tesla? The stock market is where you find each other. The 2 biggest stock markets in the United States are the New York Stock Exchange, the NYSE, and the NASDAQ. Here's how to think about it. Imagine you want to sell your used car. You could stand on a street corner holding a sign. Maybe someone drives by who wants your car. Maybe not. It's random. It's inefficient. Or you could list it on a website where thousands of people are actively looking for cars, where buyers and sellers are matched instantly, where the market determines what your car is worth based on supply and demand. That's what the NYSE and NASDAQ do for stocks. They're giant digital marketplaces where millions of transactions happen every second. Now here's where it gets interesting. When Marco's Pizza Shop went public, when he started selling shares to regular people, he did something called an IPO, an initial public offering. That's the first time a company sells shares to the public. It's like a grand opening, a debutante ball for businesses. After the IPO, those shares trade on the stock market. Marco doesn't get the money anymore. The people who already own shares are buying and selling them to each other. This confuses a lot of people. If I buy Apple stock, does Apple get my money? Usually no. Unless it's an IPO or Apple issues new shares, you're buying from another person who already owned those shares. Apple doesn't see a dime. So why does Apple care about its stock price? Okay, stop for a second. This next part will save you years of confusion. Pay attention. 3 big reasons. 1. The executives often own stock. When the price goes up, they get richer. That's their incentive to make the company succeed. 2. If Apple ever needs to raise money in the future, a higher stock price means they can sell new shares for more. And 3. Reputation. A rising stock price signals that people believe in the company. That attracts talent, customers, and partners. But here's the key insight I want you to understand. The stock price is just a reflection of what people think a company is worth. It's not some divine truth handed down from the heavens. It's collective human opinion. Sometimes that opinion is rational. Sometimes it's insane. Remember GameStop in 2021? A dying video game retailer suddenly became worth more than many tech companies. Not because GameStop figured out some brilliant business model, but because a bunch of people on the internet decided to buy the stock at the same time. The market isn't always right, but over long periods of time, it tends to figure things out. Okay, here's where most people get screwed. Pay close attention. So now you know what stocks are and where they trade. But let's talk about the part everyone actually cares about. How do you make money? There are 2 ways. And most people only know about one of them. Way number 1, capital gains. This is what everyone pictures when they think about stocks. Buy low, sell high. Simple. You buy a share of a company for $50. The company does well. More people want to buy shares. The price goes up to $75. You sell. You made $25. That $25 is called a capital gain. You gained capital. Your money grew. Now, why would the price go up? Lots of reasons. The company reported better profits than expected. They launched a new product people love. A famous investor said nice things about them. The whole economy is doing well. And why would the price go down? The opposite. Bad earnings, scandal, competition, recession, or sometimes no reason at all. Just fear. Just people panicking. This is where a lot of people mess up. They see the price drop and they panic sell. They lock in their losses. Then the stock recovers and they miss the rebound. Or they see the price skyrocket and they panic buy. They chase the trend. They buy at the top. Then the stock corrects and they're holding the bag. This is called buying high and selling low. It's the exact opposite of what you want to do. And millions of people do it every single day because they're making emotional decisions instead of rational ones. Way number 2, dividends. If you don't understand dividends, you can't understand wealth, period. This is the one most people forget about. And honestly, for building long-term wealth, it might be more important than capital gains. Remember Marco's Pizza Shop? Let's say Marco's company is now super successful, 5 locations, profitable every year, more cash coming in than they know what to do with. Marco has a choice. He could reinvest all that cash into opening more locations, or he could give some of that cash back to the shareholders. That's a dividend, a portion of the company's profits distributed to everyone who owns shares. If you own 100 shares of Marco's Pizza and Marco pays a $2 dividend per share, you get $200 just for owning the stock. You didn't have to sell anything. This is like getting rent from a property you own. The property might go up in value, that's nice, but you're also getting paid every month just for being the owner. Some companies pay dividends quarterly, 4 times a year. Some pay monthly. Some don't pay at all because they're reinvesting everything into growth. Here's the beautiful part. If you reinvest those dividends, if you use that $200 to buy more shares, those new shares generate their own dividends, which buy more shares, which generate more dividends. That's compound interest. That's the snowball effect. That's how ordinary people become millionaires without doing anything fancy. Let me give you a real example. Let's say you invested $10,000 30 years ago in a fund that tracks the overall stock market. You never added another penny, you just let it sit. With average historical returns of about 10% per year, including dividends reinvested, that $10,000 would be worth over $174,000 today. You did nothing. You contributed nothing. You just waited. Now imagine if you had added just $200 per month, every month, for 30 years. You'd have over $500,000. That's the power of stocks over time. Not gambling, not day trading, just owning pieces of good businesses and waiting. Quick check-in. If this is making sense so far, just drop a "got it" in the comments so I know I'm explaining this clearly. Seriously, it helps me know what's landing. Now that you understand how stocks make money, let's talk about the 2 main flavors they come in, because not all stocks are created equal. Common stock and preferred stock. Think of it like flying. Common stock is economy class. Preferred stock is business class. They both get you to the destination, but the experience is different. Common stock. This is what 99% of people mean when they say stock. When you buy common stock, you get 2 main things. 1, voting rights. You get to vote on major company decisions, who sits on the board, big mergers and acquisitions, that kind of thing. Now, unless you own millions of shares, your vote doesn't really matter much. 1 share equals 1 vote. If you own 10 shares and someone else owns 10 million, guess whose opinion counts more? 2, unlimited upside. If the company becomes the next Apple or Amazon, Your shares could go up 100 times, 1,000 times. There's no ceiling. But here's the catch. Common stockholders are last in line if things go wrong. If the company goes bankrupt, if everything falls apart, they pay the banks first, then the bondholders, then the preferred stockholders, and then, if there's anything left, the common stockholders. Sometimes there's nothing left. Sometimes your shares become worthless toilet paper. That's the trade-off. Unlimited upside, but you're taking on more risks. Preferred stock is different. When you buy preferred stock, you're basically saying, I want steady income more than I want explosive growth. Preferred stockholders get paid dividends first, before common stockholders see a penny. And those dividends are usually fixed, predictable, reliable. If the company has a rough year and has to cut dividends, preferred stockholders still get their check. Common stockholders get nothing. And if the company goes bankrupt, preferred stockholders stand in line ahead of common stockholders. Not at the front of the line, banks and bondholders are still ahead, but not at the very back. The downside? Preferred stock usually doesn't have voting rights. You're giving up control in exchange for stability. And preferred stock rarely goes up as much as common stock. If the company's value doubles, your preferred shares might barely budge. You're getting paid in dividends, not growth. So which is better? It depends on who you are. If you're young, if you have decades ahead of you, if you want maximum growth and you can stomach the ups and downs, common stock is probably your jam. If you're closer to retirement, if you need reliable income, if you want to sleep peacefully at night, preferred stock might be more your speed. But here's my honest opinion. For most people watching this video, for people building wealth from scratch, common stock is the way to go. And specifically, not individual stocks. This is the moment where most viewers have an epiphany. Ready? Index funds. An index fund is like buying a tiny slice of every company at once. Instead of betting on one pizza shop, you're betting on the entire pizza industry. Instead of picking one winner, you own a piece of everyone. When you buy an S&P 500 index fund, you're buying the 500 biggest companies in America. Apple, Microsoft, Amazon, Google, all of them. Some will go up, some will go down. But on average, over time, the economy grows. Businesses create value, and your shares grow with them. This is how I invest. This is how most smart, boring, wealthy people invest. Not picking stocks, not timing the market, just buying the whole market and waiting. Let me tell you about two people. We'll call them Early Emma and Late Larry, because I love alliteration. Emma starts investing at 22, right out of college. She doesn't have much money, but she puts in $200 per month into a simple index fund. She does this for 10 years, from age 22 to 32. Then she stops. Life gets busy. Kids, mortgage. She never invests another penny. Total invested, $24,000. And then Emma stops. She stops. Completely. Larry doesn't start until he's 32. He's been meaning to, but you know how it is. He was going to figure it out later. Finally, he starts. He invests $200 per month from age 32 to 65. That's 33 years of investing. Total invested, $79,200. Now, here's the question. At age 65, who has more money? Larry invested more than 3 times as much, for more than 3 times as long. It has to be Larry, right? Wrong. Emma has more money. Let me show you the math. Emma invested for just 10 years, then stopped, but her money had 43 years to compound. At an average 8% return, Emma has approximately $745,000. Larry invested for 33 years, much more money in, but his money only had 33 years to compound. Larry has approximately $606,000. Emma invested less, for a shorter time, and she ended up with almost $140,000 more. That is the power of starting early. That is what compound interest does. Time is the magic ingredient, and you can't get it back once it's gone. this is the mistake I made. From age 23 to 28, I figured it out later. 5 years of excuses. 5 years of thinking I'd start next year. 5 years of watching my friends go out while I saved nothing. Let me do the math on my mistake. If I had invested just $300 per month during those 5 years, at 8% average return, compounded over the next 35 years until retirement, $847,000. That's what my excuses cost me. That's what figuring it out later actually means. I don't tell you this to make you feel bad. I tell you this so you don't make the same mistake. Every month you wait, you're not just losing that month's contribution. You're losing all the future growth that contribution would have generated. If you're young and watching this, please start now. Even if it's $50 a month, even if it feels pointless, the math is on your side. If you're older and watching this, it's not too late. The best time to plant a tree was 20 years ago. The second best time is today. Let's bring it all together. Here's what you now know that most people don't. 1. A stock is ownership in a real business, not a lottery ticket, not a casino chip. When you buy a share, you become a part owner. 2. The stock market is just a place where buyers and sellers meet. It determines prices through supply and demand. Nothing magical, nothing mysterious. 3. You make money 2 ways. Capital gains, when you sell for more than you paid, and dividends, when companies share their profits with you. 4. Common stock has more risk but more potential reward. Preferred stock is more stable but with less upside. For most people building wealth, common stock through index funds is the way. 5. Time is the most valuable thing you have. Starting early beats starting with more money. Every month you wait has a real, calculable cost. So here's your homework. This week, not next month, not someday, this week, I want you to open a brokerage account if you don't have one. Fidelity, Vanguard, Schwab, they're all fine. They're all free. Then, I want you to set up an automatic transfer. Even if it's just $25 per paycheck, make it automatic, make it invisible, make it so you don't have to think about it. And then, buy your first index fund. Something simple, a total stock market fund, an S&P 500 fund. That's it. That's the whole strategy. Buy, hold, wait, repeat. I know stocks can seem intimidating. I know the financial world uses confusing language on purpose. I know it feels like this stuff is not for people like you. That's a lie. It's designed to keep you dependent on expensive advisors and complicated products you don't need. You are smart enough to do this. You don't need permission. You don't need a finance degree. You just need to start. I want to hear from you in the comments. What was your biggest aha moment from this video? Did the pizza shop analogy click? Did the Emma and Larry math blow your mind? Or tell me this, what's the one excuse that's been keeping you from starting? Let's destroy it together down in the comments. If this video made stocks make sense for the first time, if this helped you understand why your friends have been talking about investing, hit that subscribe button. We're building a community of people who refuse to be confused by the financial industry. People who take control of their own money. People who become their own finance buddy. The stock market isn't for other people, it's for you. It's been waiting for you this whole time. This video might literally be the moment your future self looks back on and says, that's when everything changed. Now go open that account. I'm Finn, your finance buddy. Next week, I'm dropping a follow-up video, how to start investing with just $50. Don't miss that one. I'll see you in the next one. Cheers!